Okay. Hi, everyone. It's great to be with all of you today. I'm Ken Chatur. I'm the Director of Research and Strategic Foresight at LMIC. On behalf of the whole LMIC team, I'd like to thank you all for joining us today. As many of you probably know, Canada's youth are entering the workforce during one of the most uncertain job markets in decades. With shrinking opportunities for graduates and new strength in polytechnic pathways, understanding these shifts has never been more important. Today, we're going to unpack the latest data and what it means for the next generation of workers. Our goal today is to give you a clearer understanding of how current economic and demographic forces are shaping opportunities for young Canadians, and how high quality labor market information can support more informed career and policy decisions. Let's get started. So, for those who are new to us, we are the Labor Market Information Council, or LMIC. We were launched in 2017 to address current and long-standing challenges in Canada's often fragmented and siloed labor market information system. We work at the intersection of the federal government in Canada's 13 provinces and territories. We also worked with the Forum of Labor Market Ministers, or the FLMM, to identify and work on labor market information issues. At our core, we work to improve the timeliness, reliability, and accessibility of labor market information across Canada. The goal of this is to help identify and address the gaps in accessibility and consistency in labor market information, and to foster collaboration across the pan-Canadian landscape. By doing so, we can advance better labor market information to empower Canadians to make better decisions about the world of work and workforce planning. Now, Canada's labor market information ecosystem is dynamic and changing. I'm sure many of you on this call are experiencing that in real time. And data and contributions are coming from a wide range of sources, whether it's government, individual organizations, research agencies, and increasingly private sector firms. So, how does LMIC fit into this? Think of us as a knowledge broker. We connect the disparate parts of our ecosystem to address and prioritize key challenges. We also try to not reinvent the wheel. Think of our work as complementing the robust authoritative research and data produced by organizations like Statistics Canada, as well as academic research. Our goal is to provide information and insights that are timely, accessible, and actionable for a wide range of audiences. Now, before we go further, I should clarify what we mean by labor market information, or LMI, as you might hear us call it. At the highest level, labor market information is anything that provides timely, relevant, and accurate information about the labor market and helps you make important decisions. It can manifest in a few ways. First, LMI can be information based on numbers like detailed statistics, so think employment, wages, salaries. It could also look like occupational trends and future employment forecasts. But LMI can also be the information that Canadians use to make informed decisions about their careers through informal networks or qualitative information. Today, though, our focus is going to be on the quantitative LMI we use to support career decision making. Quantitative LMI, like statistics on wages and specific skills, can be crucial for Canadians to understand where their skills may be best placed in the labor market. And this can empower Canadians to make informed and strategic decisions that work best for their individual needs. Now, please join me in welcoming today's speaker, Pete Nelson. Pete is a senior economist here at LMIC with more than a decade of experience in market analysis, modeling, and strategic storytelling. Pete's worked on everything from securities regulation and housing policy to behavioral science to helping decision makers and the public make sense of complex economic issues like the one we're going to talk about today. Pete brings that same multidisciplinary approach to his work at LMIC, and he helps us translate data into insight and insight into action. And so with that, you can take it away, Pete.
Thanks so much, Ken. As Ken mentioned, my name's Pete Nelson. I'm a senior economist here with the Council. And I want to take this opportunity to just thank you all for coming and engaging with this subject. It is something that's been generating a tremendous amount of discussion lately. And what we're going to see as we go through this webinar is that all of that attention is very well warranted. And so we're going to find out that the labor market for youth right now is very tough by historical standards. And so it's very good for everybody to come and engage with this material. And so the way that we're going to do this is we're going to start off. We're going to take a high-level look at just how tough the labor market is compared to what we've seen historically. Then we're going to jump in. We're going to see the consequences that that tough labor market can have, not only for the youth who are facing it, but also just broader for the demographic and economic considerations for Canada. And finally, we're going to look at what we consider to be the four primary drivers that are behind the tough labor market conditions that we're seeing. Okay, so what we're going to do is we're going to start off, and just to get a sense of just how tough this labor market is by historical standards, we're going to jump right into a Mentimeter. Okay, so the first Mentimeter is outside of the pandemic. The youth unemployment rate is the highest it's been in how many years? Okay, and so just a couple of definitions here, so we know what we're all on the same page moving forward. When I talk about unemployment rate, that's for the population that's out actively seeking work. How many of them are unable to find it? So, for example, if you had 10 youths who are out looking for work and one is unable to find work, the unemployment rate would be 10%. And when I talk about youth, I'm talking very precisely about the population that's between 15 and 24. Okay. Okay, so we can see 15 years, 30 years coming in. Okay, so I'm sure like it's interesting because the answers that we're seeing, if you've been following the news on this, I'm sure that you have seen this data reported. And actually, there's a little bit of a wrinkle to this question because you might have seen two numbers reported. And so I'll get into that nuance in the next couple of slides, but we have everything coming in. I'll give another few seconds just for people to get used to Mentimeter on their phone. Okay, 15 years is seems to be the winner. Okay, so we'll go to the next slide, and we see that the audience has very good intuition because actually the answer is that the youth unemployment rate is the highest that it's been in 15 years. Okay, so let's take a look at how that looks like on a chart. So we'll go to the next slide, and what we're looking at here is the annual unemployment rate going back 25 years, back to the turn of the century. And so we can see on the right-hand side here, the unemployment rate in the red bar at 14.3% is the highest that it's been going all the way back to the global financial crisis. So you actually have to go back 15 years to the global financial crisis and the aftermath of the global financial crisis to see an unemployment rate this high. Now, you know, obviously we're excluding COVID from that. And the reason that we do that is COVID was just such an anomaly. You know, the shutdowns and the lockdowns that we saw disproportionately impacted industries that hire a lot of youth. And so it's an outlier. It's very difficult to make a comparison to. But the takeaway from this chart is that you can see that very rarely in the last 25 years has the unemployment rate been at the level that it is right now. Okay, so for those of you who said 30 years, you are on to something, and we'll see that on the next slide. So we can see that if we were to take just the population that have a bachelor's degree, the youth unemployment rate is the highest that it's been in 30 years. And if we're being very precise here, actually it's the highest that it's been in 32 years. You have to go all the way back to 1993 to see this level of unemployment. And so this is a very striking result. You know, we're looking at over 35 years of data here, and you can see that where the unemployment rate is for bachelor's degree holders it's very, very rare for it to have been at this level. And so this is a very, very striking piece of data. You know, there's probably lots of people on the call today where this unemployment level is the highest that it's ever been in your life. So it's hard to overstate just how startling and striking this is. Okay, so let's go to the next slide. So that we can see that compared to what we've seen historically, the unemployment rate is very high right now. But the natural next question is, why is it so important? What are some of the consequences that we would see for the youth who are experiencing these difficult conditions? And also just for the ripple effects that it could have demographically and economically. Okay, so the first thing, and this goes without saying, is that for the youth who are experiencing just how tough this labor market is right now, personally, this is a crisis for them. It's very difficult. And so for that reason alone, obviously it's very important. But let's dig a little bit deeper and let's look at some of the consequences that are more persistent that can be experienced by both the youth and that the country as a whole might feel. Okay, let's go to the next slide. So the first thing that we see is during periods where the labor market is very tough and the unemployment rate is very high, we also typically will see high underemployment. Now, the unemployment rate is very widely reported for good reason. It's a very important statistic. It's very informative about the state of the labor market, but underemployment is also very important. And what I mean by underemployment is that when the labor market conditions are very tough, there's a lot of young folks who are going to have to settle for jobs that just they're not a perfect match for their skill sets. They're not taking full advantage of maybe the skills and education that they've invested in. It's very challenging. I mean, you have to ask yourself if we are in a position where young folks are not able to reach their full potential and their full promise, how can we expect Canada as an economy to reach its full potential and its full promise? Okay, let's go to the next slide. And so perhaps this is unsurprising because we've just talked about underemployment. But what we also see is that youth who graduate or come of age in a very tough labor market also experience lower earnings. And the important thing to keep in mind about this is that it's not just a temporary blip on the radar of lower earnings. This can actually be a very persistent effect. And so, what we saw in the aftermath of the early 1990s recession is that lower earnings persisted for nearly 10 years after the recession ended. And there's multiple reasons for this. I mean, one of the reasons, of course, is that when you have such a high level of underemployment, these young folks aren't getting the right experience early in their career to be able to go down the career path that they planned. And so this can have a big impact. You also have something where if you're underemployed and you're not fully utilizing your skills every day, those skills can atrophy. You start to get a little bit rusty. And so where you start in the labor market can have very profound consequences on where you end up. And so you see these lower earnings. Of course, this places a tremendous amount of financial stress on the youth who are experiencing it, but it also has profound economic and demographic impacts. So let's go to the next slide. So what we can see is that when you have these lower earnings, what can happen is that it delays life milestones. So, for example, folks who aren't making as much money early in their career might have to push back home ownership. Frankly, with the way the market is right now, it even makes rentals a real stretch on the budget. For folks who want to have a family, it can push back family formation because they might not feel like they're financially stable enough or in the right position to start a family. It can delay retirement savings, which, of course, has a profound impact for the people who are putting off retirement savings, but also in the future places a tremendous burden on government finances and the future taxpayers and the tax base. But I would argue that out of all of these impacts, nowhere is it more profound than the impact that it can have on consumption. So let's go to the next slide. Okay, so the reason that consumption is so important is that Canada, like most other advanced economies, is consumption driven. That means that consumer spending is really what moves the whole economy forward. It's very, very foundational for what we do. And that's why you see in periods where there's a lot of uncertainty or a lot of fear in the economy, COVID-19 certainly was very recent and comes to mind. The government will do whatever they can to incentivize folks to go out, keep spending, keep participating in the economy, and keep everything moving forward. And the reason this is so important is that, if folks go out and they stop spending and consumption falls, business revenues get hit. And so what they'll do is they'll lower investment, they'll lower hiring. This will feed back into that unemployment rate, and you'll get into a vicious cycle. And on top of that, it's also very difficult on government finances because government finances will suffer. They'll get less revenue from tax income, from income tax and sales tax. And so government revenue will be very impacted as well. And so consumption is really our engine of economic growth. We expect these 15 to 24-year-olds to be able to go out for the next couple of decades and really be the ones driving that consumer spending. And if they're not able to do it, and that engine of growth sputters, we're all going to feel it. This can have very profound impacts. Okay, so let's go to the next slide. So we can see that the youth unemployment rate is very high by historical standards. It's a really tough market. we can see that it has very profound consequences, not only for the youth who are experiencing such a tough labor market, but also just for the Canadian economy in general. It has serious ripple effects. And so naturally, we want to do something about it. We want to be able to address this and put younger folks in a better position to succeed. But before we do that, we need to diagnose the issue and try to see what's actually driving it. So now what we're going to do is we're going to look at what we consider to be the four primary drivers that are making this labor market so difficult for young folks. Okay, let's go to the next slide. So the first one, and perhaps this is not very surprising, is that economic uncertainty, recession, economic slowdowns can have a really depressing impact on labor market outcomes. And so this certainly does not only happen for youth. If there's an economic slowdown or a recession, you'll see the unemployment rate climb across age groups. It's a very tough labor market for anyone, but it's particularly difficult for youth. And this is for any number of reasons. During periods of uncertainty, a lot of times if firms do layoffs, they're going to lay off less experienced workers before they lay off more experienced workers. It's kind of the last one, first one out, mentality. You'll also see like a slow hiring, slow firing dynamic where they let attrition run and they're not going to bring many people on. It can become a very difficult market to break into for young folks for a number of reasons. But let's have a look at how the data looks. So let's go to the next slide. And again, what we're looking at here is the unemployment rate over the last few decades. But the only difference between this and the previous charts is that now we're looking across age groups. So the top age group here is the 15 to 24-year-olds. That's the red line. That's the youth that we're focusing on. The middle gold line is the 25 to 44-year-olds. And the bottom line, the teal line, is the 45 years and over group. So the first thing that you might notice when you look at this chart is it just persistently over time, the youth unemployment rate is quite a bit higher than the rate for the other age groups. And that might draw your attention, but I don't really think that that's that problematic. It's more just a function of that time of life where young people are coming into the labor market. They're still figuring out their skills and what they like to do. So there's going to be a little bit more job hopping and trying to see what fits. And because of that, that unemployment rate is going to be a little bit higher. They're coming in and out of training. And so, if they go into training, they might have to leave their job. If they leave their training or their education for the summer, they might be looking for a new job. So it's just a more dynamic time of life. And because of that, that unemployment rate is just naturally a little bit higher. I don't think that should be the takeaway from the chart. Instead, what I want you to focus on is that during periods where you have a recession, a slowdown, or a period of economic uncertainty, you can see that the unemployment rate rises across age groups, but more steeply for the youth than for the other age groups. Okay, so let's go back to the far left of the chart and look at the early 1990s recession. You can see that in the, during and in the aftermath of that recession, the unemployment rate goes up across all the age groups, but it goes up more steeply for the 15 to 24-year-olds than for anybody else. Okay, if you fast forward nearly a couple of decades, you get to the global financial crisis. Again, what you see is that the unemployment rate in that very tumultuous time, it goes up across age groups, but it goes up more steeply for the youth than for the other age groups. You get to COVID-19, and we briefly touched on why that was such a difficult time for youth unemployment, and it really is an outlier, but you can see that the unemployment rate spikes for all the age groups, and it spikes nearly 2.5 times for the youth. And so a very dramatic impact. And if you go to the far right of the chart, which is leading up to the present day, you can see that those unemployment rates, once again, are climbing, and it's climbing more steeply for the youth than for the other categories. Okay, so what's the outlook here? Well, the first thing that you might notice is that historically, when these rates have gone up, it's been during a very, tumultuous time, during a recession or a really serious financial crisis, a slowdown. And you might say, well, we're not exactly in a period of time like that right now. So what are we seeing? And what I would say is that we are in a period of time all year of a tremendous amount of economic uncertainty. And when you're facing that much uncertainty as an economy, it can have a really paralyzing impact on the labor market because a prudent thing for firms to do starts to be to just wait and see how things are going to look in the future. They're slow to hire, slow to fire. This makes it a very difficult labor market to break into. So that's what you're seeing, is that the economic uncertainty that we're facing can have not quite as much of an impact as a recession or something more serious, but it can have a very serious impact nonetheless. So in terms of how this is going to play out over the next few years, I would say it's a good news, bad news type of situation. I'll give you the bad news first, that if this uncertainty were to tip into a full-blown recession, we would probably see the labor market get tougher before it gets better. But the good news here is that you can see on this chart that whenever that unemployment rate goes up, it always comes back down. And what this is speaking to is that, being in a period of a recession or a slowdown, this is not uncharted territory for us. We have a policy toolkit for dealing with this. We've proven that we're able to get the economy going again. And every time that unemployment rate goes up, we manage to get it back down. And so in the midterm, in the next few years, especially, I would expect that this economic pressure will be alleviated and it should stop weighing so much on the labor market. Okay, so let's go to the next slide. So this one I find to be very interesting. This is talking about the demographic pressures that can impact labor market outcomes. And if you look at the discussion around the youth labor market, you see a lot of talk about this, and specifically from one angle. And that angle is that the youth population has seen very rapid growth over the last couple of years. And because it's seen such rapid growth, there's a big increase in the population. There's more people. Those people are competing for jobs. It makes it more competitive. It makes it more difficult to get a job. And certainly there's something to that angle. So let's go to the next slide and take a look at it. And what we're looking at here is how the youth population has changed year over year, going back about 35 years here. So the way to read this chart is that if we go back to the far left in the early 1990s, you can see that that youth population was decreasing for a couple of years by about a percentage point. And then when you get into the mid 1990s, the 2000s, into the early 2010s, the youth population is growing by about right around 1 percentage point a year, sometimes a little bit more, sometimes a little bit less, but it's growing gradually. You get into the mid 2010s and you can see that we're decreasing by right around a percentage point a year, sometimes a little bit less. The late 2010s, we're increasing. Post-pandemic, you see a relatively big drop because borders are closed. It's difficult to come and go. And then you see the rebound effect the next year. But generally, from the early 1990s to 2022, the rate of change of the population is pretty slow and steady, pretty gradual. Now, when you get to 2023, what you see is that the population increased by 3.5%. That's nearly 3 times the previous record rate of growth, which was 1.3%, which we saw in 2005. And in 2024, the population grew by 6.6%. And so that's over 5 times the previous fastest growth that was recorded. And so this is very, very rapid growth. Of course, this means that the population is growing very rapidly. And because of this, there's more people competing for jobs. It makes the labor market more competitive. And because of this, it will make it a little bit harder for a youth to get a job. So there certainly is something to that argument. But I think that it misses another angle that's underreported. So let's take a look at that on the next slide. And the next slide shows that there's another demographic pressure that we can see. And that's that the recent cuts that we've seen to the immigration targets and the slower population growth that have resulted because of this will cause firms and organizations to lower demand projections. Essentially, they see the population growing more slowly, so they think there's going to be less economic activity, less consumption, less spending. So what do? They reduce hiring, and that feeds back into the unemployment rate. And so let's look at that on the next slide. And so now, instead of looking at just the youth population, we're looking at the overall population for Canada. And what we can see is that the population growth from the first quarter of 2017 up until right around the pandemic is growing by between 1 and 200,000 people a year. Okay. The pandemic, of course, it's not growing very much at all. You get past the pandemic and you can see that there's a rapid period of growth where in some quarters the population is growing by a couple 100,000 or 300,000 or even 400,000. The population is growing pretty rapidly. However, when we get into the last 3 quarters on the far right, you can see these red bars here are the population growth that we're seeing lately, and it's just fallen off a cliff. Okay, it's growing much less slowly. So businesses look at data like this. They think if the population is growing less slowly, the economy, it's probably going to weigh on economic growth. There's less economic activity, less consumption, less spending. So we're going to invest less, we're going to hire less, there will be less job openings. And so this can put a demographic pressure on the labor market as well. And I don't think that there's as much discussion around this angle of it. Okay, so what's the outlook here? Well, I mean, I think it's always difficult to do these really detailed demographic projections, but I think one thing we can say with a degree of certainty is that the population growth is going to be more stable over the coming years, and the labor market will have a chance to acclimate to it. And so, because of those factors, I would expect that this demographic pressure will ease, that it won't be a weight on the labor market as it might be presently or over the last couple of years, and that this should at least alleviate a little bit and not put so much pressure on the labor market. Okay, let's go to the next slide, an interesting one. Okay, so I'm sure this is what a lot of people in the audience have been waiting for, is talking about the impact of generative AI and emerging tech on the youth labor market. Okay, so let me start by saying this is very contentious. There's really two sides of this argument. I'm sure many of you have probably seen that the Yale Budget Lab put out a piece in the last couple of weeks that was showing that they think that the impact of generative AI on the broader labor market is essentially nothing right now. To rebut that, Gad Levinon, who's the chief economist at the Burning Glass Institute, and I think is one of the best labor economists in North America right now, put out a rebuttal where he showed the same data just visualized a little bit differently and made an argument that actually it's having quite a serious impact on junior roles. Gad Levinon also put out a piece with some researchers over at Harvard that was showing the impact particularly on university grads. But this is very contentious. This is a battlefield for economists and labor market professionals right now. There's really two sides to this story. And you always, with a situation like this where it's new, you want to see more data before you draw these firm conclusions. But what I would say is that when we're sitting here and we're thinking about how to put youth in the best position to succeed in the labor market, it's not only important where we stand today in the present in terms of the impact of generative AI. It's also very important where we might be in the midterm. So 3 years down the road, 4 years down the road, or 5 years down the road, what the impacts might be. And if we think like that, it helps us be more nimble, not getting caught flat-footed if it advances very rapidly, and just starting to plan ahead. And so what I would ask you is, do you expect that the impact of generative AI is going to have a more profound or a larger impact on labor markets in 5 years than it does today? Okay, and this is the second Mentimeter. Okay, so we see the answers coming in. Yeah, I mean, so a lot of folks are saying that they expect it to have a larger impact. I do agree. I think that particularly in coding intensive professions, where generative AI has really blown past expectations, you're already seeing a clear and what I would call an indisputable impact on the labor market. And as these technologies continue to accelerate and evolve over the coming years, I would expect that the labor market impact will be more significant. And I mean, we can see here, I mean, this is reflected in the answers. Nearly 5 times as many people are saying that they think that it's going to have a larger impact on labor markets in 5 years than it does today. I tend to agree. I think that it will have I think it's a quickly moving technology. I really do think it will be transformative. And so I agree with the majority of the audience here, but there really are two sides to it. Now, going back to the present, what I would say is that if we're thinking about the impacts that generative AI might be having today, where we would see those impacts the most initially is on white collar type of workers, office work. And so what we could do, let's go to the next slide, and focus in just on youth who have a bachelor's degree and look at some of the impacts that we're seeing there. Okay. So on this chart, this is a dual axis chart. So it's representing two different things. On the left-hand side, the teal numbers and the teal line is representing the number of bachelor's degree graduates who are aged between 15 and 24. And so what you can see is that the number of bachelor's degree graduates in 2022 was just a little bit over 350,000. And by the time you get to 2025, it's just under 450,000. And so just because of the way the chart is, this line looks pretty flat, but this is actually nearly a 25% growth. And so it's a significant rate of growth. We're producing quite a few bachelor's degree graduates. And simultaneously, what we're seeing on the right axis, which is the orange numbers, and that corresponds to the orange line, is that job vacancies for bachelor's degree graduates. And so when I'm talking about job vacancies for bachelor's grads, we're talking about entry level opportunities. So jobs that ask for between 0 and 3 years of experience and that would cater to bachelor's grads. We've seen vacancies fall from the peak in 2022 by over half. And so you can see that this trend starts in the middle of 2023, really begins in earnest in 2024, and really drops very dramatically over the course of 2024. Okay, so if we were seeing an impact from generative AI, we would expect to see it hit these entry level opportunities first, because what generative AI has proven very good at is replicating the type of work that these junior roles or these entry level employees would do. But this is very high level. Okay, so if we want to get a better idea, we should dig down a layer and just see how the vacancies are moving across sectors. So let's go to the next slide. And again, we're looking at vacancy data here, but now we're looking at it across 5 sectors. And so let me just explain the chart here. The teal dot corresponds to the average number of vacancies that we saw in the first 2 quarters between 2022 and 2024. And the orange dot corresponds to the actual number of vacancies that we saw in the first 2 quarters of 2025. Okay, so for example, the top line, business marketing and HR, saw the number of vacancies fall from an average of 15,000 in the first couple of quarters of those 3 years to under 10,000 that we saw in the first couple of quarters of 2025. That's nearly a 40% drop. Software engineering and development saw nearly a 70% drop. Finance and accounting, nearly a 50% drop, and so on and so forth. Okay, so when you're seeing these areas that were previously very reliable landing spots for new grads, when you're seeing vacancies drop by this much, particularly in the coding intensive professions of software engineering, I think that this adds to the argument that generative AI is having an impact. But there's another layer that we can consider here. We can go a little bit deeper. And that is that when you hear a lot of people talk about the impact generative AI is having on this type of labor market for the new bachelor's grads, what you hear people talk about is that the organizational structure of a lot of these firms has gone from what you might call a pyramid, where you have some senior leaders and executives on top, you have some experienced, middle-level experienced employees in the middle, and then you have a broad base of junior employees supporting the entire organization. There's been talk about moving from that pyramid model to something that you might call a diamond model. And that's that you still have those executives, at the top. There's not very many of them. There's still quite a few of the mid-level experienced employees, but those bottom level, entry level junior vacancies and roles have really been hollowed out. And so there's not that broad base supporting the organization. And so if we see that, what we would expect to see is that vacancies would be falling by less for the mid-level experienced professions. So let's see how that looks. Let's go to the next slide. Okay, so now we have the exact same chart we just looked at on the left for those entry-level vacancies between 0 and 3 years, but now we're comparing it to the more experienced level vacancies that we see that require between 3 and 8 years of experience. Okay, so for example, in business marketing and HR, we saw vacancies fall by nearly 40% for those entry-level roles, but for experienced roles, they fell by only 12.5%. For software engineering and development, the vacancies fell by nearly 70% for those entry-level roles and 30 points less for the more experienced roles. You see something similar for data science, finance and accounting, so on and so forth. And so it certainly does seem like you're seeing that impact where some of the junior level roles are being hollowed out and the experience level roles aren't seeing that same impact. I mean, with like I was mentioning before, because this is emerging, you always feel more comfortable seeing more data as the years go by to really assess this impact fully. But I do think that we're seeing strong evidence of it, particularly in something like software engineering. And let's consider the journey of a software engineer when we think about the outlook in terms of what this means for the youth labor market. So if you're graduating with a software engineering degree today, you're walking off the convocation stage this month, it means you probably started your degree in 2021. Now, when you started your degree in 2021, you had every reason to think that it was an excellent path to go down. Tech firms were hiring like crazy, wage growth was very strong. It looked like a very good opportunity. And so what's happened is as those software engineers have been putting in the time and the effort and the money to get that qualification, get the bachelor's degree, and graduate, the labor market has been shifting under their feet. So whereas they might have expected to graduate to a lot of open doors and opportunities, instead what they found is a hyper-competitive entry-level job market where a lot of these jobs expect them to already have 3 years of experience. Okay, so you couldn't blame them for being pretty surprised with the labor market that they've graduated into. So what I think this means moving forward is that the labor market has become more dynamic than ever and will become increasingly dynamic as we go. You know, for most of us on the phone, if we picked a path at the beginning of our training or education that we thought was going to be a promising path, odds are it was still a promising path when we graduated. Things weren't moving that quickly. And now, as the labor market has become more dynamic, students, even as they're going through their education, might have to make these pivots or tweaks to get themselves a better labor market outcome when they graduate. And so, what this means is that now more than ever, we need to get the right labor market information in front of these young folks so that, you know, for example, with a software engineer, if they're going through their degree and they've seen vacancies for software engineering deteriorate, maybe they can make a small pivot to something like machine learning engineering or cybersecurity, something that has stronger demand. And if they make that pivot, they can get themselves a better labor market outcome. And, you know, that's just absolutely crucial for us to be able to do. Okay, so let's go to the next slide here. And this is really the last driver that we believe is creating these tough labor market conditions for youth. And this is what I've called labor mismatch. What I mean by this is that there appears to be a long-term misalignment between the type of qualifications that young people are getting and the type of qualifications and skills that employers are demanding. Okay, so let's go to the next slide and see how this looks like. So now we're looking at the unemployment rate again, but the difference on this chart is that we're looking at the unemployment rate across qualification types. Okay, so for example, the teal line corresponds to the unemployment rate for youth who have a bachelor's degree. The orange line corresponds to the unemployment rate for youth who have a post-secondary certificate or diploma. And so if you go back 30 years, you look at the situation in 1994, what you can see is that the unemployment rate for youth who had a bachelor's degree was nearly 3 points lower than for a youth who had that post-secondary certificate or diploma. And so if you had a bachelor's degree, you were in an extremely strong position. Okay, you can see that that is maintained over the 90s into the 2000s. Maybe it tightens up a little bit in the mid 2000s, but really that gap is maintained until you get into the mid 2010s. You get into the mid 2010s, it more or less vanishes. And then we've seen something really astonishing in the last few years where we've seen that full inversion, where now the unemployment rate for a youth with a bachelor's degree is actually higher than for a youth with a post-secondary certificate or diploma. And so this is really a stunning inversion of what was a very long-term trend. Okay, so why are we seeing this? Okay, let's go to the next slide and take a look. And so this slide is looking at the population growth of youth who hold a university degree versus youth who hold a post-secondary certificate or diploma. So the way that you read this is that we've set both of these populations to the same level in 1990, and we do that so that we can observe the changes over the last few decades. So the way that you can read this is that the university degree population is at base 100 in 1990. And I know that you can't see it because it's kind of far from the axis, but the university degree population is now at a level of 340. The interpretation of that is that there's been a 240% increase. So 340 subtract 100, a 240% increase in the number of youth who have a university degree. During the same few decades, we've seen the post-secondary certificate or diploma population move from base 100 in 1990 to about 140 in the present date, in the most recent data. And so that corresponds to a 40% increase. So 140 subtract 100, a 40% increase in the number of youth who have a post-secondary certificate or diploma. So you can see on this chart that there's been a serious deviation, and the population for university degree grads has grown much more rapidly. Okay, but this wouldn't necessarily be a problem. If we had a job for every one of these university grads, this would be wonderful. It would mean that we have a highly educated, highly skilled workforce, but only if we have a job for every grad. So let's take a look at how that looks. Let's go to the next slide. Okay, so this is a sequence of 4 slides, and you're going to see what I'm doing as I'm going through. But what we're going to do is we're going to compare the growth in job vacancies to the growth in the population holding that qualification. Okay, so for example, the first slide here, we have one orange bar. It shows that the job vacancies for university degrees has grown by 16% between January 2016 and January 2025. Okay, so next, let's compare that to how rapidly the population has grown. Next slide. So we can see that the graduate population holding a university degree has grown by 63% in that same period of time. So you can start to see what happens here is that our graduate population for universities has grown, university grads has grown much more quickly than the jobs that are available to them when they graduate. Okay, so now let's do the same thing for post-secondary certificate or diploma holders. Okay, let's go to the next slide. How fast have job vacancies grown? Okay, so over that same 9-year period, we've seen job vacancies for post-secondary certificate or diploma holders grow by 123%. Okay, so this is a very healthy rate of growth. I mean, you can compare it to the growth in the university degree vacancies, but how fast has the population grown? Okay, is it 40%, 50%, 60%? Just come up with a number in your head. Think about what you think that population growth has been. Okay, let's go to the next slide. And so we can see that population growth has actually been 9%. And so you can start to see what happens here is that there's been a significant job growth in the type of vacancies that would cater to somebody with a post-secondary certificate or diploma, but the population of people with that qualification just hasn't kept up. Okay, so listen, I want to be perfectly clear here. I'm not saying that we should be discouraging anybody from going to university. Just personally, university, I think, is a wonderful experience. It's a life-changing experience for me. I'm a big believer in that path. But when you look at data like this, I think that what you have to see is that there are opportunities beyond university in terms of training and education that would put these young folks on a career path that might be just wonderful for them, might get them the labor market outcome that they're looking for, get them the lifestyle that they're looking for, and just might put them in a very, very great position. Okay, so let's go to the next slide. Okay, so we've seen what we consider to be the drivers of the current labor market conditions that youth are facing. And so naturally, we want to ask ourselves, what can we do to try to alleviate some of the pressures that are on the labor market right now? And I think the most elegant and foundational solution is to provide high quality and timely labor market information. Okay, let's go to the next slide. So first, for governments, policymakers, educators, if you have access to up-to-date and very high-quality LMI, this means that you have more visibility of the labor market and the space. You can adapt training programs and supports more quickly, and you're able to do a great job of putting young folks in a position to succeed when they graduate from the programs or when they come of age. Okay, let's go to the next slide. Importantly, for young folks, having this high quality, up-to-date LMI also supports better choices. You can see, what type of skills should I invest in? What type of career path should I go down if I want to get myself a good labor market outcome? It gives them a lot of visibility and helps them make better choices. Okay, and finally, if we go to the next slide, we can see that it highlights pathways beyond university. So as great as university is, there are pathways, in the skilled trades or polytechnics or other emerging sectors that would give these youth a great career path, a great labor market outcome, and could be very promising. And by getting the right LMI in front of them, we make these paths more clear to them. Okay, so what I'm going to finish with is this. If we get the right labor market information in front of the various stakeholders in this space, then what happens is that we have better information leading to better decisions, leading to better outcomes, and it will improve the labor market conditions. Now, if we don't get that labor market information in front of these youth to help them make the best decisions and put themselves in the best possible position, then we're not only letting them down, we're putting Canada's entire economic trajectory at risk. We're really all in this together.